So one of the things, you're going to see a lot of gurus out there and talk about how multifamily, it's easy. This is an active business. So you really want to choose what your level of involvement is, especially with multifamily, because it is commercial real estate. There's a lot of moving parts. It is big dollar amounts, so there is risk attached to it there. So you really want to figure out.
A lot of properties that we purchased was off market.
Especially that price range.
And those of you that's watching this, you have to grind and don't be afraid.
What's normally going to happen is they're probably going to send you a property that is absolute crap. And that's usually a test. They're like, well, let's see what this guy thinks of this. Or maybe they'll take this, dead fish off my thing. The thing that most people do when they hit that is they either ghost the broker because they underwrite the deal and they're like, that's a crappy deal. He must have not took me seriously. And they take offense to it. Or they go back to the broker and like, oh, this deal's crap, blah, blah, blah. Like, why'd you send me such crap? Both of those are wrong. What you want to do is say,
welcome back to the DB Podcast. New episode dropping. So check it out. I got my man here, Vince. He's my partner with Tri-City, and we're going to be going deep, not just deep, but a mile deep, and talking about our portfolio of multi-family assets where we own currently about 700 units, value over $70 million, and it's just been amazing. Vince, we got a wonderful story. He also helped host the Hawaii Millionaire Mindset, the Blueprint Conference. If you have not got your ticket yet, make sure you go to my website, www.DearonneBethea.com. Click on conferences, and it'll take you right to the link and get your ticket for July 10th through the 13th, 2024. But hey, welcome, Vince, to Hawaii, man. What's going on?
Not too much. I need to get some of that energy.
Absolutely. So we're going to jump straight in there. We're going to talk about our partnership and really want to focus more because there's a lot of people in here maybe thinking that, I want to own apartments, right? And they may say, oh man, I can't, there's no way I can own apartments. But I really want to say, take a step back because there's going to be a whole lot of nuggets. Yep. I already know it's going to be talking about a whole lot of nuggets that we're going to be dropping right here. And let's get into it. So multifamily, right? Yep. How did we, get started? To grow a portfolio and, focusing on different markets. I know we started all over, started on the East Coast, then worked our way out to Texas, the great state where we really focus in keying on DFW. Mm-hmm. But just give a quick overview of where we at.
Yeah, well, you already hit it in the beginning when we were talking about mile deep, and that's the name of the game, what we're doing right now. The Tri-City portfolio is going a mile deep in a DFW. But to kind of tell you how we got to where we're at now, a lot of people listening to this, they haven't done a deal. If they've done a couple, introing in with 700 units, $70 million, they're like, I'll never get there. That's so far. But so to show you how we got here, and I've only been in this game since 2018.
Right.
So I bought my first multifamily in 2018. So I'm gonna go back a little bit and show, okay, how did we go from 0 to 700 in just a couple of years? And I'm gonna do that real quick. So my story starts with I was at Travis Air Force Base. I was active duty military. Had my first VA home loan, just like you did. House hack, my VA home loan. 2013. 2016, I was like, I want to get into this multifamily stuff. I got into things like bigger pockets, things like that. Learned how to house hack and do different strategies with duplex and fourplexes. I drained my TSP, flipped my money out of my first house I bought in 2013 when I was at Travis in California, and took all that and bought my first multifamily, and it was only a fourplex.
Right.
And I bought that first fourplex, and I got addicted to it. I was like, all right, let's get some duplex, stuff like that. And then I went from 2016 to 2018. I bought 20 units on my own, just trying to figure out, while I was stationed in Hawaii, I was buying these in the Midwest. So for those saying, oh, I can't do it, I'm in a high, expensive area like California, Hawaii, wherever, it's possible. It's easy, you got the systems and processes, right? That's how I did it. I was able to do this while active duty, without even being 3,000 miles away. It's possible. And then once I hit 20 units, that's when I was like, all right, well, I already blew through my VA. I drained my TSP. How do I get to that next level, right? Because we were talking about this game's the different levels. A little bit of education get you this far, and then you have to go back, get more education, get to the next level. So 2018, got some coaching, got some mentorship, and then I went from 20 units, and that's when I started Tri-City Equity Group. I got some mentorship, went to meetups, that networking effect, got some guys around me that were really wanted to jump into multifamily, and we went and found our first apartment building, which is a 52 unit. So I went from duplexes, fourplexes, to a small joint venture partnership, a JV, where we each put in 25%, found the asset, secured it. It was 52 units in Michigan, and that was the start of Tri-City Equity Group in 2018. We plugged away at those little small units for a while, and then you went to the show in 2020, right?
Yep.
Right around there. And then from there, it was just like, we hit that next level.
Yep.
So we hit that next level. Tri-City went really wide first because we thought that's what we wanted to do. So we were in 5 different states. We hit up to almost 800 units before we started selling stuff off. And then we realized that next step is to, you either you can go mile wide and you become kind of limited in your scale, or you can go a mile deep and become an absolute expert
SME.
and lethal in one market.
Right.
And that's what we're doing now. That's that next phase, this next evolution of Tri-City Equity Group. We scaled big, and now we're shrinking in, and we're laser focused on DFW, and we're going to go in and take it over.
Man, and it's been phenomenal because, when we started, Tri-City, we have 14 properties, right? And like you said, we went in, we started selling properties off in the past couple of years, and right now we currently have 9 assets, right?
Yep.
We just closed on December 20th last month. We just purchased in the DFW area, but it's just been phenomenal. But someone watching this right now, right? Someone's watching this. They're gonna thinking man, how do you get in it? Because I can tell you when I started, years ago, right? I was in my early 30s, maybe late 20s. I got into LP investing. Didn't know what the hell I was doing really, but I came across that path. But I started just like you, VA home loan. Not just VA home loan. I went from VA home loan to foreclosed properties and all these tax things. But it's a lot of people that's flipping houses. There's a lot of people that's buying those foreclosures and finding out that there's tax liens and whatever the case may be, mom and pops and things. But if someone want to kind of get into what we're doing, right? What some things that they should be doing? How do they choose a market and like you said, coaching and things like that?
Yeah, absolutely. So one of the things, you're going to see a lot of gurus out there and things like that talk about how multifamily, it's easy and everything like that. This is an active business. It is very active. So you really want to choose what your level of involvement is, especially with multifamily, because it is commercial real estate. There is a lot of moving parts. It is big dollar amounts, so there is risk attached to it there. So you really want to figure out kind of where the end in mind. Why do you want to get into multifamily?
Right.
What's your either cash flow goal, net worth goal? What's the driver behind multifamily? Because it is going to take a sizable investment, not just on capital, but also time.
Right.
And if you're working W-2s, you got commitments. A lot of people underestimate, and a lot of people I coach for underestimate that on their first deal. They think they're just, I got 25% down, I'm going to go buy this 10-unit apartment building, and somebody else is going to manage it, and I'll cash checks.
We know that. It's not like that.
Yep. So I would say if somebody's going to get started with it, there's a couple different avenues you can take. If you want to do it yourself and be the operator, start with the education. There's a ton of good books out there for that, different courses of that. But I think the best teacher for multifamily is to probably get a small one, even if you have to get a partnership on one, and go get a small property, because you'll probably learn more if you go buy a 4-unit apartment building and run that for a year or two, rather than just sinking all your money into some big asset. And then with a 4-unit in most states, if you mess up, it's not gonna kill you.
Right.
You might get some road rash or something like that from messing up and stuff like that.
Which is good because you learn.
You learn, but you're not going to mess up a 50-unit apartment building where I just made a $300,000 mistake. The mistakes are smaller. So I call those when I'm coaching other people, like the sandbox properties.
Right.
So you buy a little fourplex. It's a multifamily. You have to deal with tenants. You have to know a fair housing law. You got to deal with contractors. But it's small. It's manageable. Once you figure that out and build those systems and processes, then you go back to the drawing board, or not the drawing board, but you go back to the toolbox and all right, education. How do I get into the bigger properties? How do I develop those relationships with the brokers, the bankers, things like that, other partners, so I can partner up with stuff. But that's what I suggest for first time. If they've never done anything in real estate before, is go get one person, or do it on your own, and go get a small property, learn it, and then you can go get the coaching and stuff like that.
Okay, so
if you want to be active.
Right. If you want to be active, because there is a thing called active and passive. Even though on the active side we own about 700 units, but on total partner I have over 1,200 units as of today. So we'll talk a little bit more about that later. But now okay, so we gave them the blueprint on that part, right? Go get some coaching. That's the first thing you want to do. The next thing, all right, you want to choose your market, all right? Yes. And that's when we first started, we was like this. We cast this net, and man, and my one of my jobs is, just not I'm the KP, but also the director of acquisition, and I was all over the place, right? Was looking at markets in North Carolina, Virginia, anywhere south of the Sun Belt, right? It was kind of south of the Sun Belt. We were just looking, and then we say, you know what? Let's focus in. Let's choose a market, all right? And let's go to mile deep versus that mile wide. And we came up with DFW. I lived in Texas, for 10 years before moving out to Hawaii. So I was really saw the growth there. And, it's just, I also had a business. I got in my franchise. So, I've always been going back and forth from Hawaii for businesses and things like that. And, going into the DFW market, it's just been straight phenomenal for us because it's real simple. Things that we look for, all right, is where our jobs are going, because politics does play a role on sometimes like markets and things like that, because we see what's happening in New York. We see what's happening in California. We see jobs are picking up and leaving the blue states, and they pushing down in the Carolinas, in Florida, right, in Tennessee. Oh, in Dallas. And I tell you that the DFW market is one of the hottest markets because, as we know, when those jobs continue to leave, people in large migration come out here too as well. So that's one of the things for sure. But now, we tell them really just focus on like demographics, right? That's one of the most important part. The population growth, the income growth, all those things are key things that you should be looking at. And there's tons of software that's out there. You want to give them a couple software tips that they can use.
Yeah, for software tips, so when I look at a market, there's a couple different things. So you mentioned some of the KPIs: population growth, job growth, income growth. Those are top tier KPIs. If any of those are negative or even flat, we're not even looking. We're not interested. So you have to go where the jobs are going, and that's where you need to be. The other things that are less not so KPI is going to be the things like competitive advantage. So this is why I took, when I went to Michigan, was because I had a competitive advantage in Michigan. I never lived in Michigan in my life, but my wife was from Michigan. So I had a competitive advantage when I was looking for places to buy real estate. I had her whole family scouting the neighborhoods for me, driving for me. Your competitive advantage, why we were in Dallas, because you lived there for 10 years. Dallas is not the cheapest place to rent, and it might not even be the highest growth place in the country or the highest rents in the country, but we had that competitive advantage, which made it the KPIs. So the KPIs are solid,
right? And
then that competitive advantage of yours and Bob's experience there, put it over the top. And that's why we got rid of everything else. So like, we know Dallas better than any other market.
Yep.
All the KPIs are there. Let's start shedding everything, go a mile deep in there.
Absolutely.
So population growth, job growth, income growth are your top tier.
Right.
Schools, things like that. Crime rates matter. Those are under that. But then that competitive advantage.
And then just real quick, because we got so much to unfold, I want to talk about, give them a nugget. Let's give them a nugget, a software, something free though. All right.
Something free.
www. I can know one that we use.
All right. So the ones I use the most on market research. So you have Rentometer.
Yep.
Is great on rents. You have USA, Data USA.
Data USA.
Yep. You got Data USA. What is it? Neighborhood Scout is a good one. Area Vibes is a good one. The Census, .gov is a good one. What are some? So CoStar's you got to pay for.
Yeah. So then those are great, right? Those are some of the free stuff that's out there. But then there's other things that's out there. Once you get a little bigger, you can use things like CoStar. We use Buxton, and right now. But we had to grow, right? We got 700 units, but there's someone that's right here is watching this. What we're trying to tell you is that you don't have to go out there and have the best software, right?
Yeah.
So you don't have to do that.
A lot of them are free.
Yeah, a lot of them are free, right?
Yeah, because what a lot of these softwares are doing is they're all pulling from the same data source, which is the census data, and they're just kind of pulling it in, packaging it, and making it user friendly. But a lot of these paid services are getting the same data as the free services. It just, the free services, it doesn't look as good. It's not as user friendly, but it's the same exact data from the same pool.
Okay. All right. So now we in Dallas, right?
Yep, we're in Dallas.
And whoever's watching this, maybe you're in Atlanta right now. I want you to continue to travel with us, right? Yep. All right. So maybe your market is Atlanta or Tampa, Florida, or whatever the case may be. But right now, what we doing, because what we talking about, you can apply this to anywhere in the U.S. All right. So now we got there. We in the market, and someone right now that maybe having a duplex, maybe 2-3 duplexes, and say, man, how do I get into that 20 unit?
Yeah.
You know what? We started out doing things like all the way from cold calling, right?
Yeah.
Cold calling, and a lot of properties that we purchased was off market.
Especially that price range.
And and why, and those of you that's watching this, you have to grind and don't be afraid. You can look at LoopNet and all these things, but pick up the phone. I want to real quick give them some more nuggets because we giving nuggets out. Tell me some software systems that we can use. All right, that help someone to do cold calling. Cold calling only means that we have someone's phone number. We have the owner's phone number. Mm-hmm. All right. Maybe we may have a list of 200 people, right? In this price range. And we having someone making those calls.
Yeah. So this is what we did. So the best source I have, and there might be newer ones out there because we haven't done the cold calling thing in a minute, is ListSource. So you go to ListSource, and it's a service. You pay for leads, but it's super cheap. It might be a quarter a listing. And you put your filters. Yeah, you put in, I want this zip code. I want properties that are this vintage, so year built, and I want them to be maybe 4 and 10 units. And it'll list all the properties that fit that criteria in the county.
Right.
And you pay per address, and it'll give you the address, the owner's address, and usually the owner's phone number. The one thing about that is that the phone numbers probably aren't accurate. So what you then do, and a lot of people get stuck there, they get frustrated. They're like, oh, I bought this list and I called the numbers and the numbers aren't accurate, and then they give up. Well, here's the trick. So you get the listsource list, then you go to a service like Upwork, go get a VA. So you go to Upwork, you type in skip tracer, you take that list that you got, you go to the skip tracer and say validate all of these, and they might charge you 10 cents to validate, and they're like, all right, well, and they'll kick it back to you in a day, and they'll say, all right, out of these 50 listings, I was able to find the true owner and true email, thing for 45 of them. And then now you got the list of 45. You come up with a script of, who you are, why should anybody care to listen to you on the phone, and kind of build rapport, and you start cold calling. You hit those phones.
Absolutely. So, hey, now we still traveling.
And we bought millions of dollars in real estate, just like as a system that simple.
Yeah,
just
millions of dollars. Yeah. And it's been, some of our highest profit margins too. Yeah. Because they mom and pops operators, right?
Exactly. Right? And a lot of them don't want to deal with brokers.
Don't want to deal with it.
So you open up, hey, I'm not a broker. I'm a guy or a woman who lives in the same town.
Right.
I'm looking to get my foot in the door, and you'd be surprised if you start building a rapport organically.
Right.
Like that.
And which goes to my next one as we go towards this journey of owning multifamily real estate apartments, right? Yeah. So one of the things is, okay, now we out of that. Now we scaling, right? You got your first apartment. You did the cold calling thing. Because we did it about, I think, our first 5 apartments or so was all cold calling, right? Yeah. And more than that, I think, And so now we are in a market that's very competitive.
Yes.
You're talking about DFW. Right, we like, who's these guys right here? This Tri-City team, tell us about yourself. Oh yeah, man, we got properties in Tennessee and Virginia, and the broker's like, okay, but we also was in El Paso, right? So what happened was, right, we had to realize that we had to come in, and we came through we came through the back door, started south of I-35, where we started out in Waxahachie. We was able to go in, but we knew that we had to get in the market through the back door, but immediately we had to start building rapport and relationships with brokers. So that's that's where we at right now. That's kind of like my main job is the acquisition director is to find a deal, right, and also build those relationships. And we've been able to then over the past couple of years, man, we got, we was able to buy, 5 properties in the DFW market, and we talking about within 2 years. And we've been able to build some phenomenal relationships with some great brokers that's out there. Shout out to all y'all, and it's just been great them giving us a call and things like that. But broker relationships is important, right?
Yeah, absolutely. I was gonna turn the script on you, like how were you able to do that, D? How were we be able to get 5 deals in 18 months? But yeah, the broker engagement says so. When people need to make that step from MLS properties, your typical small duplex, fourplexes, to then you get into like the off market mom and pop stuff, and that usually is about probably maybe you can get up in the 50 range. Usually 30 units or less is going to be that mom and pop that you'll have really high success rate in the off-market stuff. But once you start getting up in the 30 units up, you're dealing with brokers. And a lot of people are intimidated by brokers. It's a whole different breed. A lot of them are kind of that intense personality, a lot of, not aggressiveness, but you know what I'm talking about. And it can intimidate a lot of people. So the way you're going to get through this is preparation. Before you speak with a broker, you're going to come up with a plan. And this is exactly how we did it. We got clear, right? We created our buy box, right? We had our criteria sheet. You want to tell them exactly where you're looking, what type of property you want, what type of property you don't want, what your price is, how you plan on funding it, and what your experience is. You're going to want to put this called a one-pager criteria sheet together with all these things on there. And then step 1. Step 2 is going to be, you're going to go to, the best way I did it was go to places like LoopNet, the website, or Crexy, and you're going to look at all the properties that are listed. Don't really care about those properties that are listed. You want to see who's listing the most properties. What brokerage is listing the most properties in your market? You're going to get those contact informations. You're going to put them in a spreadsheet, all those brokers' names, and you're going to create a called a broker engagement system where you're going to intentionally reach out to all these brokers systematically every 2 to 3 weeks for the foreseeable future until they remember your name. Because I'm telling you, they get so many calls a day from so many tire kickers. They're not going to remember who you are the first 3-4 times they call. They're like, who's this again? And like, I just talked 2 weeks ago. Yeah, what do you want? So and then you're kind of constantly reiterating who you are, why should they care, what your buy box is, what do they have coming up, what's in their pipeline, and then what's normally going to happen is they're probably going to send you a property that is absolute crap, and that's usually a test. They're like, well, let's see what this guy thinks of this, and maybe they'll take this dead fish off my thing, and the thing that most people do when they hit that is they either ghost the broker because they underwrite the deal and they're like, that's a crappy deal, he must have not took me seriously, and they take offense to it, or they go back to the broker like, oh, this deal's crap, blah blah blah, like, why'd you send me such crap? Both of those are wrong. What you want to do is say, Mr. Broker, thanks for sending me over this deal. You want to respond to him fast, like 24 hours or less. You want to respond to the broker. I looked at the deal. I screened it. This doesn't meet our buy box. Thanks for thinking of me. Here's our buy box again. Please think of us the next time someone crosses your desk like this. That's the game plan. That's the thing. You consistently do that every 2 or 3 weeks. It's going to take it's a slow burn thing. But how many deals we get now? We get first call now.
Yeah, first call. We get deals off market, flying out a couple of weeks.
And it took a year to get there, but we're here.
Yeah, we're here. You know what I mean? And that's the hard part.
That's the hard part.
Consistent. Staying on the grind, building those relationships. Relationships important that we always talk about here on the DB podcast. But check it out. So now we got the relationship with brokers. We know the areas and things like that. So now I want to talk a little bit more about Path of Progress. Not only Path of Progress, but different classes. So different classes are, we got A class. What is a B class, C class, D class? And, it's real simple. I'm not going to spend too much time because we got so much stuff to cover. But, pretty much D class are, that area that, we call it, where I'm from. That's the hood. It's a little bit more, low income, whatever the case may be. Then you have C class, which is the next tier class. Maybe the household income is somewhere around $35,000 to $40,000. And also, then you have the B class. That's your middle class. A class is going to be your working professionals. And with that, too, some people, depending on who you ask, they may consider a class asset based off the year of that when it was built. So sometimes you may hear someone say, hey, yeah, I got a class A, but it was built in a class D or class C area and things like that. So, those some of the things. So we talk about the relationships, talking about brokers and things like that. But what we focus on, we started out, is really focused on class B areas, all right, or B areas that's growing to an A, all right, due to, again, Path of Progress, where we see if you living in off I-95 and, maybe you're going through Atlanta, whatever the case, or Savannah, whatever the case may be, and you just see things that continue to grow, going north, south, east, west. You want to be on that path of progress. So we talk about that, and what we specialize, again, we want to be in those Class B areas, Class A areas, and we was buying value-add assets. Value-add assets that was, maybe it was a 80s built, late 70s at the time, and those would be considered a C-class property based off the age of that property, but it was maybe in a B class or maybe a C plus neighborhood that we knew that was going to end up becoming a B class, right? So we want to do value add. So I want to jump and start talking about a little bit about value add because that's our niche. That's what we're good on, right? And I say that because again, we have 14 properties, right? Tri-City, we have 14 properties that we have had, and right now we currently have 9 active properties, and we started off buying those hard, heavy lift properties in those C plus neighborhoods, C minus, mom and pops. We go in there, value add. We talk about this term value. I know people like, what do you mean when you say value add? So I want to talk about a little bit about value add, but I also want to let the people know that you want to start from the bottom because, we knew that we want to be in B and A class areas. Yeah. Now we in B class areas. Now we stepping our game, but now when we're going out to Dallas, we're going to be looking at A class property, right? Those bigger properties, bigger assets, and things like that. So let's talk a little bit about it. What's value add? I want to say, what is value add?
Yep. So value add properties, again, that's what we specialize in. So we do value add, multifamily, and DFW. That's our buy box, especially if it's 1985 or newer. So we consider value add something to where I can go in and I can force the appreciation, force the value of that property up through renovations. The trick on this is that, or not the trick, but the catch on this is when you go out to market right now, every broker is going to say every property is value add. It can be built in 2020. They're going to be like, it's a value add property. So you have to kind of know what value add is and how to be able to spot that opportunities. So when we go in, we look at different components. So one is going to be like the physical value add. What does the property condition look like? Is the exterior of the property, the grounds, the community, has it been neglected? And because of that neglect on the exterior of the property and that community feel, it's not getting the rents because it doesn't have that curb appeal. So there's kind of the outside. I always start from the outside in. So on the outside of the property, are the amenities not looking good? Is the landscaping, trees, as the buildings look like they're all faded and signage all messed up? So, and because of that, quality tenants that are coming in willing to pay more, they're not stopping at this property because it doesn't look like a place they want to live. So value add starts with the exterior. You want that curb appeal up. Start with the outside in. Once that curb appeal is up, now you got the good residents in. Now they're pulling into your property, and they're going to do showings like, oh, they got the new pool, they got the new barbecue playground area, the building's all framed, painted, the signage is fresh, everything's good. And then they go into the units, and the units look like crap because they just blew all their money on the exterior. So now, once you get the exterior good, now you go into the units. Yep. So the value add units. So now that's more of an equation, right? So that's a little bit more delicate. You definitely do a lot of secret shopping in the market and figure out what are the comps. If you're trying to get $1,500 rents for your apartment, what are the $1,500 rents in the area? What do they got? Granite countertops? They got LVP flooring? What kind of appliances do they have? Do they have dishwashers, washer dryers, things like that? What type of not FFE, but the FFE. So
FFE, yeah,
it's FF&E. So what are the fixtures and finishes of the apartment that is getting the rents? Because if you're going to an apartment and it might be $800, but it's all classic carpet, wood grain counters or laminate counters, the old white or yellow appliances just look stingy, and you're like, all right, I need to get up to everything else in the market's $1,300. What's that $1,300 unit look like? And then you build it backwards. You build out the scope of work backwards from there, and then you renovate the unit. And as long as what we look for in ours is roughly a 25% ROI on that renovation. So if I'm going to put 10 grand into a unit, I need 25% of that 10 grand on an annual basis. That's how much rent I need to increase. So that's the interior value add. So we did the exterior value add, we did the interior value add, and then what I think we really take it to the next level with Tri-City is we look for other income. Absolutely. Because other income is not the same color of money as rent. It's not taxed the same.
And got all those things.
So we do ratio utility billing. That's what RUB is. So we bill back for water, sewer, trash, pest,
cable.
We get cable. Yeah, we get cable, bulk cable. We can do covered parking if it's a place where it gets really hot or hail or something like that or snow. We can do covered parking, pay for premium covered parking. We've looked into trash valet services. All these things are fee income that a resident can get upgraded to if they want that amenity, and that drops straight to the bottom line because it doesn't have the same expense attached to it. So that actually boosts your NOI, which is the name of the game in multifamily, is the net operating income faster. So those are kind of the components of the value add that we look for is the exterior, then the actual unit, and then the other income is that kicker on top.
Right. Absolutely, man. So much to pack, man. We love multifamily, man. We love real estate, and so much to pack. I know that it's a lot, right? But we're gonna keep on going. We got to keep on going because
I'm excited now. Let's go.
Yeah, he's pumped up. Time is ticking, and then we don't got too much time. But we're gonna get into it, right? We're gonna jump from other ways that you can invest. Right now, I want to key in. We're gonna key in we went from active. Right now, we just everything we talked about was the active owner, the active role. But there's another role out there that's called passive, right? And what we do at Tri-City, we do syndications, right? Syndications just saying that we purchase large assets or multifamily, and we create a small investment group, right, where that we are able to raise capital through, creating a PPM, which is a private placement memorandum, a 506C or 506B. And again, I got to break it down a little bit because I know it's a lot. So 506B, that is a syndication or investment structure where that you can bring on your family, your friends, and but they can have up to 30 or 25 or 30 non-accredited investors. All right, well, 506C, you have to have everybody in there have to be accredited, right? Meaning that accredited investor means that your net worth has to be $1 million or more. And that's minus your primary house. All right, that's for accredited. So again, 506C is for accredited. If you don't have a net worth of $1 million, you cannot invest in 506C. And then on the flip side of that, as the owner of the syndication, all right, you can advertise. You can advertise on social media, radio, billboards, or whatever the case may be. A 506B, you cannot do that. You got to keep all your people inside your database, and you got to reach out to your family, your friends, and you limit it to only 30 people or 25. Can't quote me on that. It's 25 to 30 people that you can have non-accredited, right? Family and friends, non-accredited that has a net worth less than $1 million, and you can take on as many as accredited investors, right? So I'm going to go into it. Like I was saying earlier, we partner with about 700 units between me and Vince together with Tri-City. I have another 500 plus units on the passive side. Myself, I got into and became a limited partner LP because I went passive where I had started with single family homes and things like that, rental properties, flip properties, but then I got into it by owning, becoming an LP investor, and I got into my first one was a student housing with this Morehouse School of Medicine. It was a great investment that I got into. I was able to get a 3x return in about 3 years, and it's a lot of benefits. And we're going to peel the onion back a little bit. There's a lot of benefits because I want to talk about benefits of being passive and benefits of being active. We're going to talk about the K ones. We're going to talk about bonus depreciation. So let's jump straight into it, right? So what is, I think, between us, we high net worth individuals, even if you're not high net worth individual, maybe you're a contractor or whatever the case may be, you're making good money, dual income, and you're looking for tax savings, tax benefits. There's no asset out there better than real estate. That's going to give you the depreciation that you need to lower your taxable income with your ordinary income, and it can get crazy with it. But on the passive side, you can reap those benefits as well by becoming a passive investor, right? Because you may have some other passive deals that may, you may have had a deal. Someone made you some money on the passive side. You was an LP, you may be in a software company, but then you invest over here with us in real estate. And you were able to get the depreciation again. Bonus depreciation been very phenomenal with us. But we're going to dive deep.
I'm ready to dive
and
deep.
Let's go to it.
All right. So let me break this down. So the way I look at real estate investing, and one thing we haven't talked about yet was structuring deals. When we talk about picking markets and all that stuff. So structuring deals. The way I see when I'm talking about structuring deals is I have a toolbox that I've built over the last 8 years of doing this, of tools that I can use to take down a real estate deal. Maybe it's seller financing. I pull that tool out. Maybe it's conventional loan. Maybe I house hack my VA home loan. Maybe I use a joint venture tool. Or maybe I pull out the syndication tool. And the syndication tool has two sides. It has the active side as a general partner, which is I am, or a limited partner side, which is you're on both, right? And the name of that game is leverage. So just like we go get loans for any type of real estate, is we want the leverage. So I don't want to pay 100% for a building. So I'm going to get the bank as my partner. A lot of people when they're thinking about real estate investing, the bank is not an adversary. They're your partner.
Partners.
So you're going to go get the bank to partner with you on this deal, and you're leveraging them. You're leveraging their money.
OPM, right?
Yeah, OPM, and it's the same principle for the syndications too, and it works both ways. And I'll tell you how. So with the syndication, general partnership, we want to go run this asset. We got the time. I don't have a W-2 that's pulling my time. I'm solely focused on Tri-City. I have the teams, the experience, and all this stuff. I just need more money to go buy this building. So I leverage investors that come, those friends, those families, those communities. I say, hey, come invest with us in this, and we can take down this big building. So I'm getting some leverage on it from the bank and investors. And then on the flip side, the LPs, the limited partners, they're leveraging me because they're all working professionals. They're doctors, lawyers, engineers, pilots, whatever. They're running their own companies. They're busy. They don't got time to be, dealing with all this stuff
going on, water drain, pipe bust.
Yeah, it's Dallas, Texas right now in January. If you look on the news right now, if you went back and listened to this, you'll notice the freeze.
The freeze. Every year they get that freeze.
Last week
pipes pop and everything.
Yeah, last week I was down there walking all the properties. A lot of LPs, they want the benefits. They want the bonus depreciation, the tax write-offs and everything like that, the cash flow, the appreciation, the loan pay down, all these things that come with commercial multifamily, but they don't want to do the work. So the limited partners are leveraging us to reach their goals.
Absolutely.
So it's a very symbiotic relationship.
Absolutely.
And it's a very beautiful thing because then we got the limited partners, they're getting what they need. The general partners, we're able to scale and grow our company.
Yep.
And
it's
everybody eats. Everybody eats. Everybody's getting the tax benefits. Everybody's getting the loan, the equity from the loan pay down from the tenants. We got 700 tenants paying down our loans for us.
Right.
And we're getting equity from that. Our investors are getting equity from that. So we got the loan pay down, the market in Dallas because we got the job growth, the population growth.
There.
The market's appreciating.
We love it.
So we got the appreciation on one side. The tenants are paying down our loans. The government gives the best tax breaks in the IRS code to real estate.
Absolutely.
So we get the best tax breaks on anything, and we get the cash flow out of it.
Great.
So
that's 100%.
That's what it is. So the limited partners is a great role. If you're a busy working professional, you got your own thing going on, you want to jump into multifamily, it's a great way to learn.
Absolutely.
It's a great way to learn. So if you're like, I want to learn how these big, $8 million, $10 million deals work, let me go partner in on one, and I can learn that way just by being a partner on one as a limited partner on it. So
right. And one of the things that we talk about at the conference is, again, scaling businesses, right, to keep, create that cash flow from the business side, right, and then you shift that cash flow and leveraging someone like us so they can invest that in multifamily as a syndication. Yeah, so that's like the best of both worlds, man.
And you're not getting distracted because you're trying to I want to do multifamily and I want to run this company and start this thing. It's like I'm going to focus on my company and get that going, and then I'm going to shift the money over here, getting on that conveyor belt. Yeah,
because that's real big on the conveyor belt because, again, we building these assets so we can pass on. Mm-hmm. And the fastest way to hit your goal is, number one, you try to keep as much money in your pocket and don't give it to the IRS. All right. And real estate allows us to do that because what we are doing is we are able to keep more money. So if a investor come in and say they may put in $50,000 and they made $90,000 to $100,000, well, guess what? If they can pay less money or take that year one, they're going to get a depreciation, where we call that when we're talking about bonus depreciation, and then they can take that money and maybe they can take that money and help offset some other income. Maybe they're a business owner on a daycare or got a franchise or whatever the case, house flipper. And one of the things that we both are real estate professionals, right? Mm-hmm. That's one of the most powerful tools
really
in real estate. It is crazy. Like, limited partner is LP. And we are LP on our own deals, right? So we invest right beside you. Right beside most syndications or the promo are split like a 70-30, where the 70% of the profits or the cash flow from the water flow goes to the LP investors, right? Mm-hmm. So with that being said, as active as we are, and you may have some, I say real estate agents, because they spend their time selling real estate and they creating all this active income, right? But they ain't doing nothing with it, getting a lot to the IRS, right? And being able, because you hit those hours that are required to become a real estate professional, right? So it's like 700 hours or something that you got to work a year towards, doing real estate. And will allow you need to talk to your, I'm not a
financial advisor.
Okay, we got to make sure I'm not a CPA, but I do know I talk with my CPA all the time. We love the financial part. In fact, when I got into business, that has been the best thing that I've loved is the finance, the tax strategies, and all those. But being a real estate professional will allow me to let my CPA let the box of real estate professional, so we can turn all of my passive investing, all right, anything passive. All right, I get to claim that as towards my active income, and it's just it's been great.
Yeah, so. And the real estate professional, it's a status code with the IRS. So it's not just like I'm a real estate professional. It's an official classification code with the IRS when you do your taxes that allows you to do that.
Right. So all right. So we're talking about generational wealth. Again, there's so much to unpack. Again, if you want to learn more, just follow us, reach out to us. We're talking about generational wealth at our conference. But I really want to, before we go, I want to talk about, because you said there's a lot of, watch out there, because a lot of people out there that have been doing it for 2 years, 3 years, and then they're creating these coaching programs. And, really, what's your thoughts on that? Because there's a lot of people that's out there, but, there's people that's in the weeds just really doing it, really out there crushing it. But there's people out here right now, because we know rates, right? Rates have changed.
They're hurting.
They're hurting right now. They're selling off assets, and yes, we purchased 5 properties in 18 months, right? And what our thing was we want to sleep at night. So our goal was, let's do agency, all right? Let's do low leverage, all right? It's going to be a higher raise, all right? Let's get fixed rates. But there's a lot of
we took the harder road up front, so we can sleep easy now.
Yeah, exactly. And that harder road is, raising more capital and things like that. But
harder loans to get with the agency, more hoops to jump through.
Yeah, and we got a lot of agency loans on out there. A lot of people, I guarantee, they probably like these Tri-City guys out here, they're here buying left to right, man. We just, we good. You know what I mean? Because we position ourselves. We got an asset getting ready to sell. We paid $3.6 million. We selling the asset in today's market for $7.8 million. We close on the asset in a couple of weeks, right?
Yep.
Can't wait. All right. And we got Park Place, out there. Hey, oh my God, crushing it, And we just got some really good deals, and we got some great debt. And I know there's a lot of people out there that's out there in tight positions. But what we want to do is we want to also take the money that we make in and put it on the conveyor belt. And I want to go a little bit. Go ahead.
Well, yeah, I was gonna say. So you already said it before. You kind of alluded to, is like we want to sleep at night, and one of the things when you're talking about the active investors or the active people like the real estate agents, stuff like that, is they're not making money when they sleep, and that's what the LP can provide, right? So until you can make money when you sleep, right? That's one of your quotes, right?
You're money when sleeping.
You won't be financially free. You won't hit that generational wealth. So you have to figure that out, how to make money when you're asleep, and that's either buying the real estate on your own, kind of building your own portfolio, or shortcut that by being a limited partner, or do both. This isn't an either or scenario. That's why I was talking about that toolbox. Is sometimes I want to be an LP because I'm really busy right now. It's my peak season. I got some money I need to deploy on the conveyor belt and get it working for me. Get that money out in the street working. But maybe next summer, like, I got another $100,000 and I want to go buy my own duplex. You can do a mix of both. I have 100 units on my own, but I also have most of my equity in Tri-City, so I'm doing both. So you got to figure out how to make money in your sleep. Being in a limited partner is a way that you can put assets on the conveyor belt. You got some money set aside, you got some equity, got some IRA funds just sitting there, or some G fund stuff. They've been sitting there for 20 years. Get that money out, get it working for you while you're still doing your W-2. You don't need to wait and hold up. Just get the money working for you, get it compounding, and that's what the conveyor belt does.
You're right. And talking about compounding, we also in the middle of investing internationally. You know what I mean? We're getting ready to take a trip. Me and my man, we got a great real estate agent out there, and we're going to start to invest in Dubai. And we won't be able to invest in the outside of the United States. We want to diversify our portfolio. So
that goes back to the conveyor belt too. So that's a strategy. You want short-term rentals, I want short-term rentals, but all of that are just assets on the conveyor belt. Everything goes back to the conveyor belt. Yep. And let me break that down. So the conveyor belt, for me, in my business plan, my goal, this is Vince Gethings, is in my mind, in my business plan, I have a 5-year-long plan. And on that plan, imagine a conveyor belt that's going around. That's 5 years long. My goal, my only goal, Vince Gethings' goal, no matter all the companies I run, is to put an asset on that conveyor belt every 90 days. Absolutely. That can be through Tri-City Equity Group. That can be through my other company that I own my own personal properties through, or another business. Or a short-term rental in Dubai.
Yep.
It's an asset on the conveyor belt. That's the name of the game.
Yep. Is
every 90 days put one on there, and then at the end of the 5 years, you should have enough equity in those assets from the loan pay down, the forced appreciation from the value add, and the appreciation of the market. You're building up equity as that asset's sitting on that conveyor belt. And then at the end of the 5 years, you're going to have a capital event. Sometimes you might want to sell it, capture that equity, put it right back on, buy something bigger. Think Monopoly. Or you do a refinance, keep that asset, have a non-taxable event. If you really like that asset, pull out portion of money and go buy another asset and just keep that money recycling.
Right, absolutely.
How fast you can build equity and your net worth thinking like that, it's absolutely incredible.
Man, we are dropping nuggets, man, but we got to get ready and wrap it up. And I'm going to tell you right now, if you want to learn more, again, go to our website, www.DearonneBethea.com. You can go invest with D, or hit me up on Instagram. But before I let my man Vince leave out of here, I got one question for you. Give me one book.
One book, huh?
Yep, someone's watching right now. They want one book.
One book for multifamily. I would do the let me think here. I don't know, where's that port at? But that one probably already said that. I can't do that one, huh? Wheelbarrow Profits.
Wheelbarrow Profits.
Right. That's a good book to start multifamily.
All right, and my book is Multifamilies and More. No, Multifamily Millions. Yeah. Actually, you gave me that book to read, and that's been the best book. And you say, hey, this is the only book I read, and I read that book years ago. And it's a great book. So, hey, check it out. That's all we got right here for the DB podcast with my man Vince. And don't forget, come check us out July 10th through the 13th for the Hawaii Millionaire Mindset. Let's get it.